want to look like the person when they ask you a question, you can answer it as quickly as possible in an organized manner. I always say it's easier to negotiate from a place of preparation and confidence. And that preparation and confidence just comes from doing the work to get prepared.
Hi everyone, I'm PCT Editor Brad Harbison. Welcome to the latest Routes to Riches with Kemp Anderson podcast. So in our previous episode, Kemp Anderson and Grant Sinnott of Kemp Anderson Consultant explained why private equity has become so active in the pest control industry. Some of the things we discussed were what private equity is, why investors are attracted to pest control, how acquisitions are structured, and what drives company valuations. So in this episode, we're going to shift a little bit from understanding the market to preparing for it. So Kemp and Grant are going to share what every owner should know before selling. So I think a good place to start, Kemp and Grant, is a lot can be learned from following what some of the larger companies are doing. And so what can some of the public company filings teach small owners?
Yeah, I mean, it tells you what they care about, I think. And we've talked about this on one of our other episodes. But like what they're advertising to the market and to their shareholders and to people who are buying their stock, it kind of lets you know what they're focused on and what investors are focused on and what the market's focused on. And that's things like organic growth, acquisitions, margins, retention, route density, productivity, customer mix. And, Rollins and Rentokil both show that pest control can be a very large, durable business. But, you look at Rentokil and like it also shows that integration isn't automatic and that buying and putting companies together, it's not easy. And I think that's kind of like what we learn as we look at some of the public market, like what they're focused on and why.
What would you say though, Grant, when you come up with that list? If you had to say, okay, we listen to, we read, we watch Rentokil and Rollins and some others, right?
Sure.
What are the top 3 or top 5 consistent themes on earnings calls or annual reports, right? And we're not talking about the worst city for mosquitoes. Like what is, when we think about annual reports and quarterly calls, and what do you think would be like the top 3 or 5 things that are very consistent across the board with these industry leaders that are publicly traded?
For sure. How much did you earn?
Earnings.
How much are you growing? Because guess what? How much you grow affects how much you earn. Right. Those are linked together like peanut butter and jelly. I mean, if you're not growing, you're not going to hit next quarter's earnings target, and you're not.
Let me help you out. If you're not growing, you're dying. And I'll give credit where credit's due. I at one point had a really awesome private lunch with Truly Nolan one day, and he laid that one on me. I said to him, "Tell me what Truly Nolan's all about." And I remember him saying, we were actually at a Denny's in Orlando, and Truly looked at me and he goes, "If you're not growing, you're dying." And I went, "Ooh, I'm using that." So I think that's right.
And I think the last one is the service mix, recurring versus non-recurring. And obviously, recurring service, you only have to sell it once and you get to collect a lot of checks. Non-recurring, you got to sell it every time. So there's just more money when you sell a recurring service. And their pricing, which of course pricing affects earnings. I think at the end of the day, they are hyper focused on the big levers that they can pull and push to control earnings and how much are they going to earn, not just this year, but next year. So those are
I think that's right. But when you think about like the Rollins of the world and you think about the Rentokils of the world, right? And we're talking about growth and earnings, right? This goes back to that other podcast that we did, EBITDA, right? The E stands for earnings, right? I mean, at the end of the day, if you're not making money and you're not making like an industry standard 20-25% adjusted, you're probably not getting offers, right? So it's got to be earnings. How did you get there? right? How did you get there? And they're going to want to know how you got there. At the end of the day, the other piece that's I think is super interesting is as these companies get really big, it's organic growth, but you've got attrition, right? So it's a net after attrition. And the only way you can really meet market expectations is you've got to layer on mergers and acquisitions. And the big publicly traded companies in our space will talk about earnings, we'll talk about growth. They will talk about organic growth, and they will talk about mergers and acquisitions. It's going to take people to drive all these, as Grant said, levers. It takes good people that have been in the seat for a while and understand what levers to pull and when to pull
Yeah. And that was a lot of really great discussion about, getting your financial house in order. And in addition to, getting your financial house in order, what should an owner do 12 to 24 months prior to selling?
Wow. Uh, Clean up your financials if they're not clean. Have a CPA look at them. Make sure your bookkeeping is professional. Review your general ledger adjustments. I spend a lot of time doing that, so of course it's something that I'm
Yeah.
fixated on from a financial perspective. But track your recurring versus your one-time recurring revenue. Make sure you're coding things correctly in your CRM. Are they all just going into one bucket, or do you actually know how many bed bug jobs you're doing, how many German cockroach jobs you're doing, how many recurring monthly versus quarterly services you're doing? You know, document. If you're going to do price increases, document your price increases. Do price increases. Show that you've got a customer base that can absorb and pay you a bigger margin. Guess what? You're going to grow your business, and you're going to prove to the buyer, hey, these are customers that are solid. They're not just going to leave the second we increase prices by 50 cents a service. Um, Make sure you have clean employee files. Have you done your I-9 verifications? Has everybody signed your non-compete, your non-solicitation, your employee handbook, your practices, your safety manual, whatever you have for your business? Make sure it's clean and organized. And it's okay if you use a filing cabinet or things are on paper, but just make sure you know where those things are. So that way, when you get into a process, you're not struggling to find things. You want to look like the person when they ask you a question, you can answer it as quickly as possible in an organized manner. I always say it's easier to negotiate from a place of preparation and confidence. And that preparation and confidence just comes from doing the work to get prepared. I would also say, just from an operational perspective, if you have underpriced accounts that you're losing money on, now's the time to think about making those profitable. If if you've got that employee who you've been thinking about firing because he keeps calling out from work, get a good team in there. Do everything you can to go into the process so you're going to continue to grow. Because the last thing you want to do is get a deal, and then all of a sudden your business falls off a cliff because you're distracted by running the business. You're distracted by the negotiation process, you're distracted by all this additional work, and your business falls off a cliff. You need to keep growing through the sales process, because if something does happen, you'll still be in a strong place. So I think those are some of the most important things you can do.
Yeah, I think that list is right. I would say your question was really like 12 to 18 months, I think, was your time window before the
12 to 24, yeah. Yeah.
12 to 24. Buyers are going to look at 3 to 5 years of
All right.
historical data. When you hire our firm, we help you with that. A lot of times you either don't have some of it, or it doesn't tie out or match. There's issues. Maybe that employee manual isn't signed, or maybe you don't have assignable non-solicits or non-competes. And what I would say is that you kind of don't know what you don't know if you try to represent yourself. And when those things, if you don't have 3 to 5 years of good, clean historical data, whatever that data is, whether it's P&Ls, balance sheets, tax returns, bank statements, it could be those signed employee manuals, it could be those signed assignable non-solicits or non-competes, it could be a whole list of things, right? You don't know what you don't know. So you don't know which ones of those things a particular buyer, strategic or private equity, or maybe even a local buyer is going to weigh. And that weight is a subtraction or an addition to the purchase price. So, for example, when you hire us, we put all those things in order before we go to market, which then translates to a premium. To your question, it's really a 3 to 5 year history of a very, very clean business on all levels: financial, IT, HR, fleet, cost of goods. All avenues need to be cleaned and organized and aligned. If they're not aligned, the buyer will find it and they will want to know why these reports don't necessarily say the same thing. So your question is awesome about being prepared. I think, to me, though, it goes back further. And that's consistent, by the way, whether it's private equity or strategic. They're going to look at 3 to 5 years a year history and tie it all out before you get an offer.
Grant and Kemp, another term that comes up that, sellers maybe don't know or familiarizing yourself with is rollover equity. And can you guys explain how rollover equity works?
Yeah, I think maybe just taking a step back,
Yeah.
there's a lot of different ways that people can structure deals when they're buying a business. Um, I think if we all had our way, I would want 100% cash. That doesn't happen, right? I'm a show me the money kind
Preferably
of guy.
$100 bills.
I'm a show me, yeah, $100 bills, exactly, yeah, in a briefcase
In
that
a,
the
in a
IRS
actually
doesn't know
duffel
about.
bag, a
Yeah, in a
really
duffel
big
bag,
duffel bag.
delivered at the day of closing. But I think there's a lot of ways that you can get paid, right? And there's a lot of different ways that people structure deals based off the risk in the deal. If you have a key employee, there might be a clause in the deal that says, hey, we're going to give you an extra $100,000 in 12 months if that guy's still here. And the other thing they might do is they might say, hey, we're buying your business and we want this to be successful. If the business grows, we're going to pay you a little bit extra in 12 to 24 months. Rollover equity is basically just another reward system. Instead of giving you cash, they're giving you equity into the merged business unit or into the platform or into the holding company that bought you. And they're saying, hey, come take a ride with us. We're doing a really great job of putting all these businesses together. We're going to give you 10% of your deal in stock in our company. And what you're doing is you're hoping that they do a really good job. And when they go to sell that stock, you have a second payday. And the thing I'll say is, like, you hear those disclosures on TV where they read 1,000,000 miles per hour, but it's like, you know, it can go really bad. It can go really good. And you've got to know what you're signing up for, just like when you buy any stock or when you make any investment. And what you're doing is you're taking a little bit of your money and you're accepting that stock. Ultimately, you're hoping it's going to go up in value. But I think you got to ask a lot of questions. What kind of stock are you getting? Is it common shares? Is it the same? What kind of voting rights do you have? Do you have no voting rights? What are you signing up for? And there's a
A
lot of
shares, B
involved.
shares, C shares,
Yeah. Yeah.
right?
Yeah.
It's a mouthful.
Exactly. And it's like, what are you signing up for? And I think you got to ask a lot of really hard questions because I think we all know what cash is, you know, but we don't all know
Well,
what an instrument is that you're getting in the
yeah,
company. Yeah, go
but
ahead, Jim.
let's think about this for a minute, right? I think you're right, but let me hit you with a couple questions. Have you ever seen rollover equity in a strategic deal?
No.
No. Key. Do you see them in private equity deals?
Yes, of course.
Yes. Okay. That's key, right? Strategics aren't doing that. Strategics are doing cash. Number one. Number two, if you have a $5 million, let's just take a $5 million transaction, and they say they want to take 20%, $1 million, and put it in rollover equity. How much are you getting at close?
$4
You're
million.
getting 4 million. You're not getting 5. Is there a risk? Is there a risk that rollover equity does not bring home the $1 million you left behind?
Of course. And there's also
What
the chance that it could be worth $2 million. It
it
could be
could be
worth
worth
0
2
or
million.
it could be worth
So
3.
now the deal is 6 million instead of 5, but it could also go to 0. So now the $5 million deal is 4, right? And because it's private, and you could ask the question, have you ever had a bad investment in your private equity firm? Have you ever gotten out, right, and not hit a home run? Well, the answer is typically, oh, we always, we've never had that. Well, you know, baloney. Um, Look, nobody picks winners all the time. Um, Private equity firms do lose money from time to time, and that can happen. And if that happens, and you're the seller that did rollover equity, you could get hurt. And that's the point I'm trying to make. Nobody picks a winner every time. And the point I'm really trying to make is that there's risk involved. It rollover equity, you have now chosen as a seller to roll over or invest instead of receiving cash, right? And that allows a private equity firm to buy at different multiples, because now they didn't give you 5 million, they gave you 4 million.
Yeah. And I think,
So these are some really key points here, and I'm going to go back and say you don't know what you don't know unless you've done this a time or two. Go ahead, Grant.
yeah. And I mean, like, there are brands that we all know and loved, at least in my childhood when I was growing up. Toys R Us was bought by KK&R, Bain and Vernato back in 2005. And in 2017, they filed for bankruptcy because they bought it with a lot of debt. And I mean, Kemp, I've heard you say this, debt makes you sweat. I mean, some of these deals are leveraged. They're not just using cash to buy them. They're going to the bank and they're getting additional fund. But guess what? That debt needs to get paid back.
Absolutely.
And, they bought a toy
That
store and
diminishes the return,
yeah,
which diminishes the equity rollover, right? And all I'm trying to say here is, look, the job of the private equity firm is they want to buy you. And their job is not to give you the most. The job is to make the best deal for their investors, their limited partners. At the end of the day, odds are you'll be fine. But what I'm trying to point out here is that there's risk, there's big risk. Even when I was at Royal Palm, we had a significant line of credit. And so to Grant's point, private equity firms do use debt. And to the degree debt does make you sweat, and to the degree that the debt becomes overly burdensome, the return on investment and the rollover equity gets diminished. And that's all I'm really trying to say is it's not all, rainbows and butterflies and hey, leave $1 million behind and we'll magically turn that million into 2 or 3 million. That sounds good. That sounds good. And that might happen, but it might not. And that's all I'm trying to say.
I've never met a stock picker who told me he picks bad stocks. So, there's just sales. Part of it is sales. And I think people are wise to remember that.
And they're selling that again to as they sort of play uh, the ROI game, and if they're not giving you that million and you're rolling it over, then that's great, because that's another million they can go spend somewhere else.
Exactly.
Well, that was a lot of really great advice for sellers, and kind of along those same lines. Um, getting back to kind of what we talked about with selling to PE-backed buyers, what questions should owners ask a PE-backed buyer?
Who owns the company? How long has the fund owned it? Um, how much debt is on the business? I mean, we just talked about that, right?
They're probably not going to answer that one, but it's a great question to ask.
How many acquisitions have you integrated? Can I call all of them? Can you give me the name of everybody?
How many brands are you trying to operate right now?
Do you keep them local? You going to keep my name? What happens to my employees? Well, can I talk to somebody after? You might say you're going to keep all my employees, but can I talk to somebody whose business you bought? Who will my team report to? What systems will change after closing? Will my benefits change? They
Will the
could be much
benefits
better
change?
benefits.
Will the payroll change? These are questions. Benefits and payroll are questions that if you don't understand, that's the quickest way to watch your new employees leave. Uh, at the end of the day, when these deals happen, the employees are going to want their pay and benefits to either be unchanged or better. And that's really critical. There's nothing quite like going to a branch announcement about an acquisition, and if you want to feel like a gut punch and immediate heartburn, um, it's seeing employees leave during the announcement because you're saying things that aren't good, at least from the employee perspective. So part of the challenge I would say is if I'm asking questions, I'm going to ask them to be based around the human side of the business, right? Are you going to change my employees' benefits? Are you going to change their pay? Are you going to uh, acknowledge their tenure with me, the seller, so that if they were with me for 10 years, now they're with you for 10 years, so they get that benefits package of a 10-year employee? These are the things that lead to successful transactions or otherwise.
Yeah. And I think one thing that's worth noting is a lot of people think, oh, I sold my business, I got my briefcase full of money, I'm out. A lot of the times in every deal, there's going to be some portion of the deal that gets held back. And usually that portion of the deal, 10, 15%, is contingent on certain business goals being met over the next 10 to 13 months. Um, which is why you want the business to be successful. And I think to Kemp's point, those are the questions you should be asking to make sure the deal is successful so you get that second briefcase of money.
Yeah, if you get a letter of intent, right, and the letter of intent has a holdback, um, you better understand the holdback and how it works.
Yep.
And those are fair questions, right? And that could even be tied back to the equity rollover, right? If you're thinking about equity rollover and you're a pest control owner and you've been in the industry for 30 or 40 years and you're sitting across the table from somebody from a private equity firm who looks at this as a financial play, the questions I'd be asking are the questions that you know as a pest control owner that make a successful business. Because if the business isn't successful, your rollover in equity is probably going to lay a giant egg. So you really need to be on your game mentally and understand how to connect these dots, right? What questions should I ask? Could even be dictated by the deal that I'm contemplating, right?
Absolutely.
And it's just that as we're kind of wrapping things up, I know Kemp and Grant, there's a lot in the industry. There's a lot of discussion, a lot of maybe misperceptions about PE and misunderstanding. What is one or a few things about PE that you would like to demystify?
I think some people say my company is too small for PE. The reality is it may be too small for a platform, but it may fit in as an add-on. And the one nice thing about private equity coming into the market is there's more buyers, sophisticated buyers, And if you have a business in a market where they're trying to buy things, you might have somebody who's willing to do that deal. And it'll be a lot easier than listing it on Biz Buy Sell or going to your uncle or your friend's brother-in-law and trying to sell it to him. Having more sophisticated, credible buyers in the market is, I think, a good thing for the industry.
Yeah, I agree with that. When I think about demystifying, I'll go back to the first podcast on private equity. There's over 4,000 private equity firms in the United States with over 3 trillion in assets. There's roughly 50 in the pest control industry. I mean, private equity is not taking over pest control. It's not. They're here. They're probably here to stay. There's 15 on the top 100 out of those 50. So they're good at scale, right? They may not even be that good at pest control, but they're good at scale. How do we get 15 of them on the top 100? Because they're good at scale. They're good at driving the business and consolidating, right? The other thing I would demystify is, hey, if you're thinking of selling your pest control business, and you're going to go meet with the private equity firm, hear me loud and hear me clear, please. They're not pest control companies. They're never going to be a pest control company. They're investment firms. They are investment firms. There's a lot of good people in private equity, but they are not in pest control. They are here to acquire. They are here to consolidate, and they are here to sell themselves for a greater return. And that's, to me, the demystifying piece. The pest control industry is not being taken over, but there are a lot of good players that are here to stay, at least, for probably a 5 to 10 year window, which is pretty typical. So I think that's it. It's not an invasion of private equity. It's not. They're here to stay, and a lot of them are just going to come and go. And they're going to come in small, maybe 5, 10 million, whatever they can get for a platform, and they might leave at 50 or 100 and sell for 300 or 400, who knows. But they're going to exit.
Well, Kemp and Grant, thanks so much for these insights. A lot of takeaways from today's podcast, including, like we talked about before, it's the best time to prepare for your company's sale is long before you're ready to sell. Private equity is here to stay, and it's good to have more buyers coming into the market. It's a sign of a really healthy pest control industry. So a lot of great food for thought when it comes to private equity. And thanks so much for joining us and sharing these insights, Kemp and Grant.
Thanks, Brad. Thanks, Kemp.
And thanks everyone for listening to today's podcast, and have a great day.